Good afternoon. Welcome to the TheoTrade Afternoon video. I'm Blake Young, and today is October 30th, 2025, and we're going to talk about wants. And by wants, I mean consumer discretionary that are the first to go in economic struggle. So we're going to look at not only the companies that are maybe going to lose revenue because consumers are going to use them less, but also those companies that are struggling to meet their bills, as we've talked about over the last couple of weeks. To start with, I do want to highlight that we hit the top of this level and we hit the resistance. We bounced down. S&P 500 looks like it's going to close below this low, which means I would expect us to fill the gap down here to 677. If we go down to 677, well, that will certainly give you another 1% drop or more, and we could go into the next downtrend. But we don't want to just simply short and fade the market off the highs. We would like to see the worst of the worst for those opportunities. And again, that's going to take me back to consumer discretionary. Now, if we look at consumer discretionary here, I want you to notice of the stocks inside of consumer discretionary that we have companies like Amazon, Tesla, Home Depot, McDonald's. Now, I don't think those companies are necessarily going to get hit initially. These are not the first things we abandon. We don't abandon Amazon because we still buy a lot of the needs and basics off of Amazon. And Amazon's being driven by Amazon Web Services, not just consumers. Tesla, I don't think tightening the belt a little bit this month is going to change Tesla sales. People that are going to buy them are going to buy them. People that are on the edge and fringe, they're going to not be buying a Tesla anyway. Home Depot and Lowe's, number 3 and number 7, are benefit from slowdowns as well because we see consumers making the repairs at their own homes rather than paying someone else or paying contractors. So contractors might get hit, while Home Depot and Lowe's can still maintain. McDonald's obviously is a discount McDonald's obviously is a discount restaurant, so I don't think they get hit. We don't abandon that one first. We abandon sit-down restaurants. But Booking, absolutely. And Dash is the one that's most interesting to me. So in this top 10, I'm very interested in Dash and Starbucks for bearish and Booking potentially, but the ones that have bad financials, we're going to start with Dash. We'll get to some others that are not on this top 10 list, but Dash is the one we're going to start. Now Dash, if we look at the chart, Dash is certainly rolling over and giving us lower highs through here, and maybe lower highs, lower lows. So I want to look at the opportunity to be able to sell and take some premium here, or trade a longer term trade down to 240 and potentially all the way down to 200. So if I go to the Trade tab, well, let's start with the Analyze tab. Analyze tab, just to show you the financials. The reason why I think Dash is going to struggle. If we scroll down on Dash, you can see their fixed charge coverage ratio is -40. That means their earnings to their fixed charges, their monthly charges, leases, equipment payments, etc. They are -40 ratio. So they've got negative earnings and 40 times that in debt. So this is not great for Dash. If we look, we can see that their revenue has already been sliding. Net revenue, net income, and earnings per share, negative, or falling. And so when the consumer gets stretched, they're going to, yes, stop going out to eat. They may still stop in McDonald's, but they're not going to pay someone else an extra $5, $10, $15 to bring them the food from one of these restaurants. They're going to give up on having it delivered. Now, I get the idea of Dash. I love the idea of having any food you want delivered to your door. But when things get tight, we're not going to spend that extra money. I would like a Giant to carry me around and give me little Hostess snacks all the time. But again, not very realistic in this economy. So instead, I expect Dash to slow down. I expect their revenues to get worse. I expect their net earnings to get even more net negative. And therefore, this trade sets up pretty nice for a downtrend that could either just be a short-term trade or a long-term trade. Now, if we scroll down to the bottom, you see current implied volatility current implied volatility rank is -58, which means we want to be a collector of premium. Now, the easy trade would just be sell the front 3 or 4 weeks or a front month worth of options and sell a short call vertical. Now, if I sold the short call vertical, I would be looking at the 267.50, that's a 42 delta, and a 270. And this is going to give us a $1.20 credit for a 250 wide spread. Now, normally I'd say we need 25 cents per dollar wide. That means 62 cents per 250. This is twice the amount, but the spreads are pretty wide here. So I would be willing to accept anything from about 80 cents or higher. You might not even get a fill on this right now as we go to the end of the market. This might just be a little bit too much volatility and too wide of a spread to get a fill. But again, anything about 80 cents or higher, and certainly if I can get $1.20, this is a pretty decent trade setup to collect that premium. If I wanted to look longer term, and I said I do think we're going to drop down to 200, I would go all the way out into January, February, even March, and I'd create that diagonal. And the diagonal, what I'm looking for is I'm going to look to buy a delta near 70, that's 310, and I want to get paid this extrinsic value. Now, if I'm going out to March, that means I have November, December, January, February, March. I have 5 months worth of time to collect $9 to turn this into a positive time decay trade. If it doesn't move, this becomes a positive time decay trade and I make the money. Now watch, this is even better than what it looks like. If we paid $63 and we're needing to pay off 9, and we go back up to that March time period and turn this into a diagonal, what we're going to do is sell a delta between 30 and 40, and we're going to collect at 245 all of it in the first 3 weeks, let alone the next month. So we are going to collect $10.30 theoretically every single month, which means we're going to collect an additional $40 to $44 before we get to that March vertical, or by the time we get to that March vertical. By the time it goes from a diagonal to a vertical, we're going to collect $40 more. This is going to become a $12 cost or a $10 cost for a spread that is worth $65. This is a really significant diagonal. You could end up spending $10. And by the way, if it's moving lower, we're rolling the prices lower and lower and lower. This could be even bigger. You could end up with a 6-to-1 reward risk ratio where we've completely covered all the costs of the trade from day one as far as the time decay is concerned. Now, Dash is not the only one. Something else to take a look at, Dash has people doing the buy now, pay later for food. One of the best ones to look at for bearishness and something that will go away either because they aren't lending anymore or because they're getting defaults is Affirm. Now, Affirm I've been watching for a while. I've been waiting for this to break down. This is a nice rollover and breakdown. I like the idea of Affirm going back down to 50, 48, 57 specifically, and even all the way down to fill the gap and trade to 40. But as we're setting this one up, Affirm is a buy now, pay later company that does not necessarily lean or loan against assets. If we look at the Analyze tab for Affirm and scroll down and look at their financials, yet again, their fixed coverage charge ratio is -12. Their revenue, net income, and earnings per share have been sliding in negative. Their 3-year average, 5-year average, and current is all negative on net income and earnings per share. They are losing money by lending money. And this is without going into massive default. If the markets and the economies get really tight, you will see defaults. And if we see defaults, this is going to set up for even worse financials and a faster downtrend for Affirm. If we go into the trade tab and we look down here at the implied volatility ranking again, we have a 50% implied volatility rank. A 50% implied volatility rank again tells us we want to be sellers of premium. And if I can be a seller of premium, I will look to sell that call vertical. Let's do the same structure setup. We'll do this quickly. Same structure setup. We'll go to the front month. We'll sell a delta between 40 and 50. 42 is the highest I will go. If I sold the 42 and bought the next strike out, 42 delta is what I'm referring to. That's the 74 strike versus the 75 strike. There's 25 cents per dollar wide. It's right on the edge. I would like to get paid a little bit more here, but this is certainly set up to pay me enough to make this worth my time by selling that delta up there. And as long as it doesn't go up, we could have Affirm climb to 74, and yet we're targeting a much lower move. Let's do the diagonal like we did with Dash. So we're going to go out to March. We're going to go to a delta of 70. And let's just use the 95 because that's what I have on the chart. And that's a 68 delta, close enough. So we're going to buy this 95, and again, notice we want to get paid 390 of time decay if we can. So I'm going to buy the 95. We'll go back up to November and say, what if we sold the delta between 30 and 40? Well, there's a 41 delta, 67, and they're going to pay me 530. So I've collected all my time decay. I'm instantly in a long diagonal put spread that is actually positive time decay. And if I can get another $5 for 4 months, $5 or more, I'm going to bring my cost down to $5 for an $18 spread. $28 spread. $5 for a $28 spread. And I just roll, every time we get to the end of that month, we just roll it out to a delta of 30 to 40 again and collect another $5. The last one we're going to look at is a non-necessity that I think is a good one to bet against, all puns intended, and that is DraftKings. DraftKings is reaching a new 52-week low. It's going to be, today, is going to be the lowest close it's had in the last 52 weeks. Not the lowest price, but the lowest close. Lowest close price we've had in the last 52 weeks. If you're one that likes to buy 52-week breakouts for bullish trades, you should also be interested in buying puts or selling short stock at 52-week lows. And this is the setup for me here. I do think you have an easy target of 20% drop in DraftKings from a technical perspective. Again, we can go to the Analyze tab and look at the financials. The financials will tell you that, yes, they're in trouble. They have a negative fixed coverage charge. They have downtrending revenues, negative net income, and earnings per share, almost identical to the other two. And if we go to the Trade tab and scroll down and look at their implied volatility rank, we're at 64%. Now, this is the one that gives us the best spreads. So this gives us a higher current implied volatility rank and has better spreads in the bid and ask. So we can start with the short call vertical. Short call vertical at 32 versus 33. That's a delta of 40. If we sell that one, again, what do we want? We want 25 cents per dollar wide spread. This is going to give us 27 cents, and that's a reasonable trade to take for 3 weeks. But the diagonal looks better. So if we were to go down to March yet again, go to a delta near 70 yet again, that's going to be the 37.50. We're paying $1.36 of intrinsic value. Remember that $1.36. If I pay for this trade, we want to get paid $1.36 if we can for the front month. If we sold a delta between 30 and 40 at 29, we're going to get paid $1.62. So yet again, this becomes an instantaneous positive time decay long put vertical or diagonal that we're hoping to get paid every single month for the next 4 months, about $1.50 to $1.60. So if we get paid just $1.50, we are going to collect an additional $6, and our cost is going to drop down to about $1. And the spread that we're going to be in is about 8.50. So it's going to become an 8-to-1 reward risk ratio by the time we get to March if it doesn't move. If it just stays where it's at, it would become an $8.50 spread, and our costs are going to drop down to $1. We'll get an 8-to-1 reward risk ratio. Now, if we get to our target, even better. If we get the opportunity to roll down and lower and lower and lower, even better than that. We could turn it into a bigger spread and completely pay for the trade. So I like all three of these for bearish trades to go against the unnecessary, the wants of the market. Betting against Dash, Affirm Holdings, and DraftKings. That's going to do it for me today. Thank you for watching. Join me again next week, and have a fantastic night.